Hi, this is Sylvia from IFRSbox.com and you're watching the short summary of the standard IAS 19 on employee benefits. This standard was significantly revised in 2011 and the changes apply for the period starting 1st January 2013 or later. So in this video, we will look at the newest IAS 19 version. The main objective of IAS 19 is to prescribe accounting and disclosure for various kinds of employee benefits except for share-based payments that are subject to IFRS 2. Employee benefits are usually provided for employee service or work that he or she does for the employer. In exchange, employer provides salary, paid leave, bonuses, and other forms of benefits to the employee. Therefore, the standard IAS 19 requires application of so-called matching principle, which is to recognize a liability for that benefit when employee provided service to employer, and to recognize expense when the employer consumes the benefit from employee's work. IAS 19 classifies employee benefits into four main categories. The first one is short-term employee benefits that are payable within 12 months after the end of the reporting period and are provided to the current employees, for example, salary, paid annual leave, or paid sick leave if paid within 12 months. The second category represents post-employment benefits that are paid after the completion of employment and are other than termination benefits. Or in other words, they are provided for employee service rather than due to termination of employment. Also, if some short-term benefit like salary will be paid after completion of employment, it does not fall to this category. So what's in it? For example, pensions, retirement bonuses, post-employment medical care, etc. The third category is other long-term employee benefits that are simply other than short-term benefits, post-employment benefits, and termination benefits provided to current employees. For example, jubilee or anniversary bonuses, deferred compensations, long service leave, etc. The fourth category represents termination benefits, and these are quite different from other three categories because they are provided in exchange for termination of employment rather than for employee service. For example, severance payments, bonuses for accepting the termination of employment voluntarily, etc. As you can see, each category has its own characteristics and therefore IAS 19 deals with each category separately. Let's take a look to the first category, short-term employee benefits, that are employee benefits other than termination benefits that are due to be settled within 12 months after the end of the period in which the employees render the related service or do the related work. Short-term employee benefits include items such as salaries, wages, and related social security contributions, paid annual leave and paid sick leave, profit sharing and bonuses, various non-monetary bonuses for current employees such as paid medical care, housing, car, or free haircuts provided by Google. The accounting treatment is quite simple in this case. Employer recognizes these benefits as an expense or maybe as an asset where permitted by the other standard, for example as cost of conversion of inventories according to IAS 2. On the other hand, a liability or accrued expense is recognized in the amount of an expense less amount already paid. The second category of employee benefits defined in IAS 19 is post-employment benefits. These are employee benefits other than termination benefits that are payable after the completion of employment. Examples of post-employment benefits are retirement benefits such as pensions, various post-employment insurance or medical care plans, etc. There are two basic types of post-employment employee benefits: defined contribution plans and defined benefit plans. It is very important to identify whether we deal with one or the other one because accounting treatment is totally different. There are two main differences between the two that help us to make clear distinction and classification. First, it's where the entity's or employer's obligation starts and ends, and the second one, who carries actuarial and investment risk of the plan. In a defined contribution plans, the employer has usually obligation just to contribute certain amount to the fund and nothing else. Then employee will get benefits from this fund based on the amount of these contributions, investment return on funds assets, etc. And therefore we can say that actuarial risk and investment risk fall on employee. On the other hand, in a defined benefit plans, employer has usually obligations to provide agreed benefits to current or former employees. For example, when there is a collective agreement signed with trade unions stating that employees will receive certain benefits at retirement, then the employer must pay those benefits regardless any contributions to the fund. And therefore, actuarial and investment risks fall on the entity. If the assets in the fund are insufficient to meet expected benefit, then employer must find other resources to pay it. Now, let's explain relatively simple and straightforward accounting for defined contribution plans. Well, as the employer's obligation is limited to making contributions, no actuarial assumptions are necessary here. It is that simple. Entity recognizes contribution paid as an expense in the period when employee renders the service. Where other standard allows, contribution can be included in the cost of another asset, for example into cost of property, plant and equipment in line with IAS 16. On the other hand, entity credits liability or cash depending on whether contribution has already been paid or not. Of course, when payment of contribution falls beyond 12 months after the end of the reporting period, it's necessary to bring it to the present value using the discount rate that we will talk about later. So let's start to explain what accounting treatment is prescribed for defined benefit plans. Let me illustrate the basic principle of defined benefit plans on a simple scheme here. Here, there is a certain employment timeline of the employee who was hired in 20X1 and we assume that he stays with the company until his retirement in 20X41. Now, let's say that the company provides retirement benefits to all its employees based on employees' final salary, years in service, etc., and that benefit is payable when employee retires. But because it's defined benefit plan, we cannot account for expense and liability at the time of retirement. Instead, we must spread the expense over full employment period in this case. So simply speaking, we must accrue some expense every year of employee service. When we look to actual current date, that it's let's say 20X10, our employee is in service for 10 years. So, as he has been serving for the company for 10 years, the company should have recognized certain portion of expenses and liability for benefit that will be payable in 30 years when the employee retires. Well, of course, not full benefit, because employee will earn significant portion of that benefit in the future years of service. Company just recognizes portion of the benefit already earned by the employee, so for the periods from the start of employment until the current date. And thus we are coming to the present value of defined benefit obligation, which is the present value of expected future payments required to settle the obligation resulting from employee service in the current and prior periods, just as shown with this bracket. This defined benefit obligation builds gradually year by year, just as employee works for employer. Current service cost, it is the increase in the present value of a defined benefit obligation resulting from employee service in the current period. Well, in other words, it's the expense for the benefit in exchange for employees' work in the current period. Now, employers can face pretty high liabilities at the end of employee service, and therefore some of them have a fund or plan to which they might make certain contributions in order to cover liabilities from benefits in the future. And thus they protect themselves from big cash flow variances and they literally make savings for future payouts. So when we want to show net defined benefit obligation from this employee benefit in our financial statements, we must deduct the fair value of these plan assets from present value of obligation. So that is an outline what the defined benefit plan is, and now let me explain its accounting in several steps. First of all, we shall estimate the deficit or surplus. It is the present value of defined benefit obligation less fair value of plan assets, if there are any. We must determine the ultimate cost of benefit first, and then we have to discount it in order to determine the present value of the defined benefit obligation and current service cost. Then we can deduct the fair value of any plan assets from the present value of the defined benefit obligation. The next step is to determine the amount in the statement of financial position or balance sheet, which is basically our surplus or deficit from step 1, but adjusted for the effect of asset ceiling. Step 3 is to determine the amounts in profit or loss. And the last step in defined benefit plan accounting is to determine remeasurements of the net defined benefit liability, which are to be recognized to other comprehensive income. In order to measure present value of defined benefit obligation and current service cost, an entity must apply actuarial valuation method, and IAS 19 prescribes using the projected unit credit method. This method sees each period of service as giving rise to additional unit of benefit. Well, what does it mean? Looking to the employment timeline, let's take shorter employment of just 7 years from 20x1 to 20x7. Each year of service represents separate unit of benefit, and an entity recognizes each unit of benefit in individual years of employee service. Moreover, each unit shall be measured separately to build up final obligation. When measuring those units, we must not forget that the whole post-employment benefit obligation must be discounted to present value. Well, I've published another video illustrating the projected unit credit method, so please check it out. Determination of deficit or surplus involves also incorporation of various actuarial assumptions, calculation of actuarial gains or losses, past service costs, treatment of plan assets and other items, but let's keep it simple in this short summary. After dealing with all calculations, we shall determine the amounts to be presented in the statement of financial position. IAS 19 requires presenting all the numbers as one single number in the statement of financial position, which is net defined benefit liability or asset. So we can have a deficit, that's when the present value of defined benefit obligation is greater than the fair value of plan assets. Equally, we can have a surplus, and that happens when the present value of defined benefit obligation is lower than the fair value of plan assets. If the result is surplus, we must adjust it by the effect of asset ceiling, which is the present value of any economic benefits available in the form of refunds from the plan or reductions in future contributions to the plan. Let's take a look to the amounts to be recognized in profit or loss. Employers should recognize the following to profit or loss: current service cost, we have already explained it, then any past service cost, and that's the change in the present value of the defined benefit obligation for employee service in prior years that results from a plan amendment or a curtailment, any gain or loss on settlement, and the net interest on the net defined benefit liability or asset, and that's what you charge each year as the obligation is discounted to present value. We shall also determine the remeasurements to other comprehensive income. These are actuarial gains and losses in full amount, and those are simply speaking differences between our actuarial assumptions and the real thing, right? Then a difference between actual or real return on plan assets and interest income on plan assets calculated by the selected discount rate. And any change in the effect of asset ceiling. So that was just an outline of defined benefit plan accounting, really like from an airplane, as this topic is very complex. Another category of employee benefits is other long-term employee benefits. These are all employee benefits other than short-term benefits, post-employment benefits, and termination benefits. Examples of other long-term benefits are long-term paid absences such as long service or sabbatical leave, jubilee or other long service benefits such as lump sum remuneration at 50th birthday of employee, long-term disability benefits, profit sharing and bonuses, and of course any kind of deferred compensations paid 12 or more months after the compensation is earned. Now, recognition of other long-term benefits is a bit easier than recognition of defined benefit plans because these benefits are not subject to so much uncertainty as defined benefit plans. Therefore, service costs such as current service cost, past service cost, and gain or loss on settlement, net interest on the net defined benefit liability, and also remeasurements of the net defined benefit liability shall be recognized to profit or loss, or to the cost of another asset if permitted by another IFRS standard. The last category of employee benefits is termination benefits. This category is different from previous ones because here, the event that gives rise to benefit is termination of employment and not employee service itself. Termination benefits are employee benefits payable as a result of either an entity's decision to terminate an employee's employment before normal retirement date, or an employee's decision to accept an offer of benefits in exchange for the termination of employment. The entity or employer shall recognize the expense and liability for termination benefits at the earlier of when the entity can no longer withdraw the offer of those benefits, or when the entity recognizes costs for restructuring in line with IAS 37 and involves the payment of termination benefits. IAS 19 also specifies the criteria and situations when the entity is really obliged to pay, like existence of termination plan, etc. Basically, employers should measure termination benefits at initial recognition and account for them depending on the nature of benefit. If the termination benefits are enhancement to post-employment benefits, then the entity applies requirements for post-employment benefits, just as we have outlined earlier with some small differences because no attributing of benefits to the periods of service is necessary. Otherwise, if termination benefits are expected to be settled within 12 months after the end of the reporting period, then the entity applies requirements for short-term benefits. And if the termination benefits are not expected to be settled wholly within 12 months after the end of the reporting period, then the entity applies requirements for other long-term benefits. So, that was just a really short summary of IAS 19. If you'd like to learn more, please visit the website ifrsbox.com and subscribe to the free IFRS course and find more IFRS stuff there. Bye bye and thanks for watching.